going to be on debt market and how to increase retail participation. For this session, we have two very learned people, Mr. Bhushan Kedar, who is Director, Funds and Fixed Income Research from CRISIL Limited, and we have Ms. Lakshmi Iyer, President and CIO, Debt and Head Products, Kotak Mahindra Asset Management Company. So, with that, warm welcome to both of you. Without further ado, Bhushan, over to you for your presentation on this subject.
Sure. Thanks, Alok. In fact, what we thought would be, interesting to do is we could actually start, overview of the market to begin with, and then of course we can get into very specific aspects of, asset allocation and link it to retail space. So with that background, what we thought would be good is, may I request Ms. Lakshmi Iyer maybe to, begin with, her sort of thoughts, and then probably I can join in shortly. Over to you, Lakshmi. Thanks.
Thanks, Bhushan. Hi, Alok, and hi, very good afternoon to all of you. Firstly, I hope in these pandemic times, we're all absolutely taking precautions and safe and secure in your respective homes, offices, etc. This is the new world normal, and I think markets sooner than later, it's been almost 9 months, markets sooner than later have more than comfortably got adapted to the new normal, and as have the market participants. The topic for today is quite an in-depth topic which will require volumes and volumes to be written and said. However, obviously we have a very short period of time here, so what I thought would be appropriate to give the audience a landscape of where the bond markets in India stand today. Within that, how do mutual funds score? And then probably, we thought Bhushan can take over on the asset allocation part. So that's the two parts, two brief parts, I would say, and I promise to keep it extremely short because bond markets tend to get a little bit monotonous and boring, especially for those who don't track this on a day-on-day basis. So I think for starters, just to give you a perspective, everybody knows what the Indian GDP is. Everybody knows where the market capitalization of etc. But if one were to glance through what is the current debt market valuation, this would be dated by about 2-3 months, but nothing dramatic. The total size of the bond market is close to $1.5 odd trillion, and even at this kind of a size, we are among the top 5, at least in Asia, obviously not in the world. And more than 90% of this bond outstanding are actually investment grade bonds. So they are all triple B minus and above. So that is the entire diaspora of how the Indian bond markets are structured. What is interesting is not really the size, but I think what's really interesting is what is the ownership pattern of this $1.5 odd trillion. The ownership pattern is quite significantly skewed towards the banking sector in India. And actually before that, I think it's important to know for the audience here that out of this total debt market outstanding, the sovereign bonds, which is the central bonds and the state bonds put together, close to a little under 70%, and the balance 30% belongs to the corporate bond space and the bank bonds, etc. Now, the ownership pattern is quite significantly skewed, therefore, towards the banking sector. So, a little under 40% of the total ownership of these government bonds, as I told you, out of the total outstanding, little under 70% is sovereign. So, in that, the government bond pattern of ownership is about 40%. Thereabouts with the banking sector, about 1/4, about 25-26% with the insurance companies, and then you have a whole host of other institutions who are very, very negligible players, but nevertheless, mutual funds, for example, are just 2% owners of Government of India securities. Of course, they do own corporate bonds, which are a bigger chunk. The Reserve Bank of India owns close to about 15 odd percent. intuitively, the central bank buying has expanded their balance sheets. Now, this perspective for you was very important to get a color as to how, if you wish to participate in a market like this as a retail investor, how will you really go and participate in a market which is so heavily skewed towards institutional players like banks, insurance companies, corporates, provident funds, mutual funds, FPIs, foreign portfolio investors. Now, if you look at the foreign portfolio ownership of government bonds, it would be just about 1%. If I take corporate bonds, it would be another percent odd. So they're not really big participants in the bond markets in India, unlike they are huge and meaningful participants in the equity markets in India. Reason for that, twofold. A, the inflow of foreign capital is very guarded in India as far as fixed income goes. So there are limits or quotas, as you call it. So you have to keep bidding for limits. Right now, the limits are open, but it's because of other considerations like currency, etc., which has kept them away. So clearly, retail participation can be forthcoming through an avenue called mutual funds, which offer debt, which offer equities, which offer hybrid. So Bhushan will take you all through the entire financial asset allocation pattern, etc. But again, just to put the numbers in perspective, right, we are talking about a 28 lakh odd crore industry, of which about 50%, so about 13 and a half, 14 odd lakh crore belongs to fixed income, and the remainder is in the form of equities, balance, hybrids, or ETFs, etc. Now, why I'm giving you all these numbers is to tell you that the retail participation in equities is significantly higher compared to the retail participation in bonds or in fixed income. The reason again for that is twofold. A, uh, when you talk about market risk, volatility, fluctuation, etc., you seem to be, as an investor, very okay to take that on the equity side, because equities is meant to take the risk. But the moment you flip that argument in favor of fixed income, the mindset is, I want fixed returns, I want assured returns, which mutual funds can never give. And that is the reason, if you look at the household saving pattern in India, more than 50% find favor with bank deposits, about 20 to 25% or find favor with insurance products, and then the residual is split across whether it's currencies or mutual funds is just about 7 to 8%. Now, I think here is the key point that I want to drive home today amid this audience is that there is a potent vehicle called mutual funds. There is a potent method or a way of participation of the into the bond markets. Assuming even if you don't want to participate in mutual funds, you can buy direct bonds. So these are methods available. These are time-tested measures shown to have the potential. Again, there is nothing cast in stone. They have the potential to have outperformed traditional mode of investments, and time and again we have seen that, especially in a scenario like this, where interest rates have been falling like nine pins. The uncertainty because of the pandemic has led to significant amount of liquidity in the banking system, and obviously bankers will not need our money at the current juncture, or they will want to take it at their rate. So effectively it is my way or highway. So a banker can effectively tell you that take my rate or you can go elsewhere, because there is abundance of liquidity. And it's not just in India, there is the rest of the world which is having a similar problem. However, as I said, depending on your risk appetite, there is that much that you can achieve. For example, take very very simple products like the liquid category funds, which are close to about 5.5 lakh crores industry, are predominantly, and when I say predominantly, almost near 99% held by institutions. Now, if institutions who are the financially savvy people have understood the benefit of parking their very, very short term surpluses in liquid fund, Why can't it be extrapolated to retail India? For example, my father does not have his money in my liquid fund or any liquid fund for that matter. He does not have his money. And after a lot of persuasion and explaining to him that, look, your money is lazy money, it's just lying in your account, bank account. If you need it, you have redemption available at 24 hours. You just need to plan accordingly, and everything is now in the last 3 to 4 years. He has started parking money in liquid funds, and he is extremely happy about it. And you'll be surprised, it's been such a long time, there's hardly any time where he actively has utilized that money, which otherwise would have just stayed into his bank account. So here and there are, and this is just one example which is very close to my heart, because I got my own father, who is like a senior citizen, to get to do this. But and of course, and many other strategies basis his asset allocation and risk appetite. But I think this is the way, because otherwise it will always be a chicken or egg story. Everyone wants returns, nobody wants to take the risk, but they want to outperform. And I keep hearing this all the time. And I just got off a con call a few minutes back, where this one investor wants is not happy with the falling rate on his portfolio, wants to diversify, wants to augment his returns, but does not want to take undue risk. And so here is the, take on it, that when you are investing in fixed income, there is an interest rate risk, there is a credit risk, and there is a liquidity risk. When you are investing via mutual funds as a vehicle, you are trying to eliminate the liquidity risk, because there is a daily NAV available in open-ended funds using which you can transact. However, the interest rate risk and the credit risk is something which you have to fathom on your own, which is why there are advisors in the country who are advising basis the risk appetite. Or if you believe that you are a DIY investor or do it yourself, you can absolutely go and do it on your own. Either which ways you look at it, I think there is absolutely no second thoughts or doubts in my mind that diversification happens at two levels. A, definitely at the asset class level, where you decide you want financial assets, physical assets, etc. So that is one level diversification. But when you talk about fixed income, since that is the topic of our discussion today, even within fixed income, there is a very, very strong case for diversification. And when we talk about diversification, we are talking about having exposure not only in, say, traditional mode of investments like a bank fixed deposit or a PPF or a small savings. That is one part of it. But to assume that that is going to be the entire fixed income, I think that is where the fallacy lies. Incrementally going forward, and we have already seen this in the past, though past is not going to suggest anything about the future, but fixed income across interest rate cycles has proven its mettle as an effective diversifier. So it is extremely important for each one of you to assess where your risk appetite is. And as I said, if you cannot do a DIY, there's absolutely no harm in digging into the services of an advisor, because I keep telling this to everyone that even the amateur anyways needs a coach, even the virtuoso needs a coach. So it doesn't matter whether you are an amateur investor or a virtuoso or a arrived investor, it definitely helps with some bit of advice. So I think I will stop here and leave the thought with all of you that there is, this classic debate which keeps happening as to should the traditional mode be preferred rather than the more conventional source mode of investment. And then my vote on this is it's not either or. There is a very strong case for complementing your portfolio with all these kinds of strategies, because once you invest in non-guaranteed, like fixed deposits are guaranteed products, small savings are guaranteed products, once you break out of that and diversify, you get the potential for market upside in this current interest rate scenario, where we are expecting interest rates to remain stable with a slightly benign or a downward bias, there is a reasonably high chance that the market linked participation can actually act to your advantage. In fund management parlance, what we call it is the alpha generation potential. So, on that note, I will pause here, and once Bhushan is done, we can probably open up the Q&A. Thank you.
Sure. So thanks, Lakshmi, for I think giving a very good overview of the market and of course drilling down on some of the products as well. What I'll try and do over next few minutes is try and talk about from a retail investor standpoint how the investment process goes, and then link it back to what Lakshmi spoke about, and then eventually link it to I think the theme that we also working with, how retail participation in the debt products or fixed income markets can sort of grow, and I will just basically try and link that. So firstly, as an investor, retail investor, or for that matter, I would say individual investors, be it retail, HNI, ultra HNI, clearly everybody begins with financial planning process, and key components of financial planning process is each one of us have very specific goals to sort of achieve. It could be goals varying from could be a child's education, or for that matter a foreign holiday, to buying a asset, or it could be anything. It'll it is something that we probably have planned for or thought for. Each one of these goals actually have a timeline. You are as an investor looking at specific time horizons over which you would want to achieve that. Now, when we want to achieve some of these goals, so there are, and if you were to look at it differently, some of these goals could be very short term, short, mid, long term. So each one of them have a different time horizon to achieve. The second important element, not all of us are have very similar risk profile. Some of us could be extremely risk averse. Some of us could be more balanced, I would say moderate. Some of us could be extremely aggressive. So one, of course, depending on the kind of or risk appetite that we have, we approach any investment plan that we want to work with, or an asset allocation that we would like to go ahead with. Extremely aggressive investor might be okay with equity plan, but if you were to marry the two and say that if this is what I can take in terms of risk, but I have a goal to achieve it in the next 1 or say 2 years time frame, then can I simply trust an equity plan to go ahead with and ensure that if I have a corpus of 100 rupee, I want it to grow to 120, 130, can I straight away get into equity over next 2 years and achieve that? Or keeping this in mind and say that, okay, instead of going full hog into equity, look at 50-50 of equity and debt, where debt will give me say anything between say 6% to 9%, depending on what product that you're getting into. And equity, of course, it can vary from maybe say 10%, it can go negative, or it can be maybe more than that. Of course, there is high degree of volatility even in debt products, as Lakshmi pointed out clearly. Is there is volatility, and of course, depending on what kind of product that you on the debt side you choose, will give you that specific risk of either upside, or sometimes there could be capital loss if the interest rates turn the other way. So there are certainly risks, but in given a specific asset and risk profile, and we choose a specific investment product, it will give you that much more comfort in terms of to plan for your investment. And depending on either a short term or a long term horizon that one is really looking at, basis that the asset allocation that needs to be determined, how much to get into equity, how much can get into debt, how much can get into say alternates that probably one could be interested. It could be real estate, art, etc., commodity. So I think these are some of the options that are there with us. But clearly, debt as an investment product plays an important role because of its characteristics. So one, clearly there is a fixed coupon that is associated with it, and if you invest in a product which is basically a fixed maturity, it has a very specific time horizon. There's a great chance of, you invest, you basically getting all the principal and the return that you were working with. Of course, depending on the risk, product, or the credit risk, or other risks that are involved, I think depending on that, you would be able to achieve your financial goals. And I think that is where both, I think, the financial planning and asset allocation plays an important role. And as Lakshmi pointed out, debt is an important element for us, to invest, because one, of course, clearly is diversification. As you invest in, so they, we say that don't put all your eggs in one basket. So it's important to choose different asset classes. The asset classes also have different correlation, which some of the assets which probably are doing badly, the other assets may give you that upside, or protect the overall wealth erosion if in bad times. And of course, this second aspect we spoke about is stability. So it is important to have debt as one of the key components of the asset allocation. That's the first part. The second element is getting into product selection, and Lakshmi did speak about two ways in which you could really invest in any fixed income products. One is the direct route, so you invest in bonds issued by corporate. There are a lot of NBFCs which do issue NCDs or corporate bonds. There are tax-free bonds, or maybe in the higher segment, there are also MLDs, market-linked debentures, that one can really invest in. On the indirect route, clearly mutual funds, pension funds are vehicles. There are also indirect investments that we land up doing in the debt markets, but sometimes you are not really aware of what asset or what allocation that has been done. So clear case is of say, employees provident fund, or insurance product that you might have invested in, ultimately also goes on to invest in debt papers, bonds. So that's how one really does investment in debt and debt products. The market has not really grown. I mean, the direct retail participation is very, very low. And if I was to just share a number, largely the retail participation can be seen, one, based on the amount of public issuances of bonds that have been done in the market. So if I was to just quote a number, say typically on a year, generally about 6.5 lakh crore has been getting issued in the bond markets, of which generally about 40 to 50,000 crores is generally comes to public issuances. So if you look at the number, it's actually less than 10%. The remaining money actually is invested in by the institutional investors, and hence it's an institutional market. And of course, there are clearly other reasons why the market is not from the retail perspective is not growing. And if I was to just look at some of the challenges that are there, so one clearly is, I think, awareness. And I will actually quote the survey which SEBI had done in around 2015, 2016, and it was done. The survey was done across urban and rural households. Of course, the survey was also done with a lot of market intermediaries. The findings state that there are about 13% of the urban investors or household respondents were actually were aware of debenture as a product. And the same set of respondents said 99.9% of the respondents were aware of fixed deposits. And of course, the other products were sort of lying in between, in this range. Of course, there were a couple of assets which were probably awareness was lower than 13%, which would typically be, derivatives. But the point that I'm just trying to drive is awareness is extremely low. Though the respondent did mention that they would want to invest in bonds, but the proportion was just about 20%. So the key point is, one, the awareness is extremely, extremely low. The second piece, which Lakshmi also pointed out, ability to participate both in the primary market as well as secondary market, I think is limited. We spoke about the supplies that are there, which indicates the primary supply to retail stroke HNI investors in this space. Likewise, if you actually go to the trading in the bond market, if you were to sell a specific bond or a buy bond from the secondary market, the market is largely driven by institutional investors. There are large size trades where you actually have a good price discovery, so to say. I know at least for the higher rated entities, which Lakshmi also spoke about, there is a skew. But if there is a retail transaction, say which is less than 5 crore, it could be a 10 lakh or 5 lakh or maybe less than that sort of a transaction, you may not be able to fetch the kind of price that you are expecting, even if you may see trades for a similar issuer or a same entity at a very different yield. You may have to take a hit on price because the liquidity is sort of quite not there. So I think that is another reason for lesser participation. Thirdly, I think the complexity of the product and in the equity, probably it's relatively easy to understand. Sometimes you see the price, you trade, etc. Sometimes the factors, you read that in the news paper, and which is also, because it's popular, so it also gets discussed. But in case of debt, there are terms like duration, modified duration, policy changes, global factors, and all of those things, actually convexity, and there are so many things that keep coming in, and they at times tend to confuse the investors. And I think that is one reason why maybe some of the investors, we believe, might be sort of abstaining from this market. And lastly, I would say one key challenge also could potentially be is lack of tailor-made products to meet the needs of the investors, to meet their financial goals. And I think I'll just talk about that in the solutions part. So I think this is how the market has either grown or not grown. I mean, these are clearly the challenges. When we start talking about solutions, clearly the cycle, the investment cycle of the investor needs to be assessed, looked at, and then there is a role that has to be played by each of the entity, be it policymakers, be it SEBI, RBI, government, or for that matter, manufacturers, asset managers like mutual funds, pension funds, or research houses like ours, or advisors. I think all of them will have to play a role to ensure that these challenges are sort of taken care of. And let's begin with awareness. There have been maybe series of measures that have been taken by SEBI, which actually, on the capital market side, have been coming up with products. But clearly on the debt side, there's a room for creating more awareness. On the mutual fund side, we have seen great initiatives taken in last few years, and the awareness on the mutual fund side is much higher, probably what we would have seen a decade back. I think a similar initiative campaign, which also can be sort of looked at, awareness program, training programs can be looked at, and I think that's where policymakers like SEBI and intermediaries can play an important role to explain risks which are there, and how these products can really help you achieve financial goals. I think is a critical element. Or for that matter, even the how to register your grievance is also an important element of the whole investment cycle that that we are talking about. Secondly, the role of manufacturers, asset managers, creating products which actually can meet the goals. You can help meet goals that individuals actually have. And when we put it very simply and maybe crudely, typically we have goals year wise, and you say you have in 2023 I want to do this, in 2025 I want to do this, 2028 I want to do this. So creating products, packages which will probably take care of some of the diverse risk profile individuals have, basis that if there can be packages or sub products which can help achieve target value or corpus for different set of investors based on the years. If there is something that can be created, which I can understand is more standardized, at the same time it is customized for some of the investors, the way they look at. And I think FMP and a lot of roll down products that we see on the mutual fund side have been catering to this requirement. But I clearly believe that there is more room for creating more and more of these products. Maybe look at a different sub products within that over a period of time. I think that is one thing that can clearly be done. And of course, it can also address the issue of risk appetite. So investors who are actually investing, who are more risk averse, want to look at government security, they can actually look at government security and state level SDL linked products. Who can probably take risk. You can actually have corporate bonds, also part of the overall package, etc. So I think this is one part which is on the manufacturing side. Thirdly, the role of I think research, advisors, as well as research agencies like ours. Definitely, there is research on the product level, which could be on, say, mutual fund, pension funds, is actually put out where the portfolios are either ranked and both in terms of performance data, in terms of NAV, how they have moved vis-a-vis some of the other peers, etc. is put out, as well as the kind of risks that are there in each of this portfolio. If you look at a bond portfolio, Lakshmi spoke about those 2-3 key risks that are there, which is credit risk, liquidity risk, or for that matter, concentration risk, interest rate risk. All of these risks are actually evaluated by research houses. They put out that research, and I think that is if you were to actually do the do it yourself pattern, this is one guide for you. But beside that, even the advisors can actually rely on their own research as well as some of the external research while talking about these products and evaluating these products. I think that is one area where we are also seeing regulators like SEBI playing an important role to shape the overall framework within which these entities operate, the kind of discipline that they need to have. I think all of that is happening. I believe there is clearly a room in that space to sort of do more. And lastly, just to sum up, I think the way the markets have on the retail participation is extremely important. The large, given that large amount of household savings that we've been seeing, actually goes into I think bank fixed deposits. Some of the money, as probably we also see, is there's surplus liquidity that we keep seeing in the marketplace. There's also need to move that capital actually to areas such as infrastructure, corporates, to support I think economy, and that the routes which are, say, indirect routes, maybe could be mutual fund, pension fund, insurance. I think all of those routes can actually help channelize these household savings, retail savings to these areas which are sort of also more productive from economy standpoint, and help us sort of boost the economy over a longer period of time. I think this is how if I was to sort of sum up, this is how retail savings can play a role, and how different intermediaries, policymakers can play an important role in shaping the markets and economy effectively very well in the long run. Thank you for patient listening. Over to you, Mr. Alok Churiwala, to take it forward. Thanks. I think you're on mute.
Yeah. Okay. So there are a couple of questions that have come from the viewers, and I would request either or both of you to address them. The first one is: we have plenty of debt instruments listed on the stock exchanges, but they don't have any liquidity. What can be done to improve the same? Lakshmi, you're on mute. You have to unmute yourself.
Same problem every year. I'm saying that this is a very common problem where it's always a chicken or egg story. Investor says, I want liquidity and then I will invest. Whereas the bond issuers say that only more and more participation happens, that is when we get liquidity. But yes, today the fact of the matter is, at the current juncture, only way to resolve for this liquidity is have more secondary market volumes. See, typically what happens is the investors, whether it's a retail investor or a wholesale investor, they buy these bonds and they fill it, shut it, and forget it. So it's just a fixed income instrument for them. They don't really want to trade on it like they do it in equities, which is why there is a significant liquidity mismatch. So as I said, the only way to do is the two ways is, if you are still keen on owning direct bonds, then you yourself try to quote two ways. Because you hold the bond, you should be a buyer or a seller. Have market makers. We have been engaging with the regulator to have market makers, to be able to create a vibrant secondary market for these bonds, which will make it obviously accessible to the retail investor. And till such time, obviously, if you are a buy and hold investor, you should be good. Otherwise, the suggestion would be to explore mutual fund route, wherein you have, a 24-hour liquidity by virtue of being an open-ended fund.
Bhushan, your take on this? Anything further to add?
Not really. I think Lakshmi had a
Okay.
sort of perfect answer, I would say so.
All right. So market makers could perhaps be an answer to the problem. There's another question. Many listed entities are quoting at a price much below the issue price. Would it not be a good idea to allow the issuer company to buy back the entities at a discounted price, at least from the retail investor?
You want me to answer that?
Yeah, please. Anyone.
No, so the answer to that is, if the issuer needs more money, then why would he or she want to buy back? And the price at which a bond is trading in the market is a function of two things. One is obviously the view on the interest rates. Second is definitely and most certainly the outlook on the individual company. And if in case both of these are favorable, so your outlook on the company is favorable, outlook on interest rates is super favorable, then there is seldom a chance where the security or the bond will be quoting at a discount. And vice versa, if your interest rate view is not very great, and to top it up, even the view on the issuer is not very great. So there is a very higher chance that the bond would actually trade at a discount. So I think one cannot really expect quick fix solutions out here for the respective issuers to come and buy back their bond. That will be purely a function of the issuer's willingness to use its surplus resources either for the growth of the business or to buy back the bonds if he or she believes that they are getting a good deal. We seldom find the latter as a base case scenario, because companies, at least in the current COVID scenario, are in the cash preservation mode. And I don't think it's a generic expectation, or should not be a generic expectation.
Okay, thank you very much for that. I think we've had a very engaging session. Thank you both, Lakshmi and Kedar, for demystifying the debt market for us. And we will now move on to our next panel.